Your boss fires you tomorrow. Where does the money come from? If you only have one answer to that question, you're standing on a trapdoor. The IRS found that almost every millionaire has between 3 and 7 answers. That's not being greedy, that's the difference between surviving and drowning. 75% of these millionaires came from nothing. Poor backgrounds, no inheritance, no trust funds. Started in the same $155,000 debt hole as everyone else, sometimes deeper. So what changed?
One equation. That's it.
Income minus expenses equals cash flow. Sounds basic, right? Almost stupid simple. But watch what happens when you actually apply it. If your monthly income is $5,000 and your expenses eat all $5,000, congratulations, you're running on a hamster wheel until the day you die. Zero margin, zero freedom, zero options. But here's where it gets interesting. Save just 5% more? You shave off 8 years of work. Not 1 year, not 2, 8 entire years of your life back for 5%. Think about that. The average American blows $18,000 a year on stuff they don't need. Takeout, subscriptions they forgot existed, impulse buys. That's $18,000 that could literally buy back a decade of freedom. Now, the wealthy? They don't sit there with spreadsheets tracking every coffee purchase. They don't care that on Tuesday the 14th they spent $4.87 at Starbucks. That's exhausting. And exhausting systems fail.
What they do instead is stupidly simple. Automation.
Paycheck hits the account. Fixed amount goes straight to savings. Another fixed amount goes to spending. Everything left over at the end of the month, they know exactly what they can invest. No tracking, no guilt, no willpower required. But saving alone won't make you rich. And this is where people get it wrong. Here's what the IRS actually verified about millionaires. Nearly all of them had multiple income streams, 3 to 7 different sources. Not because they're greedy, because depending on one income source is the riskiest thing you can do. Your boss says you're fired, and suddenly your entire financial life collapses. The math is brutal. You can only cut expenses so far. Even eating instant ramen every day costs money. But income? That ceiling doesn't exist. An extra $100 a week changes everything. Now, what do you do with extra cash flow? 90% of day traders lose money. 90%! They're staring at charts, buying and selling 20 times a day, convinced they've cracked some code. They haven't. The math is brutal. If you miss just the 10 best market days over a 10-year period, you lose 66% of your gains. 2/3. Gone. Because you tried to be clever. Someone tells you the market's crashing in 2 months? They're guessing. You're making 2 bets when you try to time it, that you'll get out at exactly the right moment and get back in at exactly the right moment. The odds of nailing both? Basically 0. The alternative is boring. Invest consistently. Every paycheck. Up market, down market, doesn't matter. Let compound interest do the heavy lifting. Here's how compound interest actually works. Save $1,000. Get 10% interest. Year 1, you make $100. Cool. Year 2, you make $110, because now you're earning on $1,100. Year 3, $121. The curve goes exponential. This is why most of Warren Buffett's wealth happened after his 50th birthday. He started investing at 10 years old, but compound interest needs time. Decades of time. And when the market crashes, stay in. Over a 40-year period, there were 11 crashes and bear markets. The people who held through all of them, they came out on top. Every single time. The last piece? Invest in knowledge. Books. Videos like this. Conversations with people who know more than you. An $8 book contains decades of someone's expertise. That's the best return on investment that exists. Nobody taught you this in school, but now you know.